Hello everyone, this is Dari here. Hope you're well. Today we want to talk about harmonic patterns in the Forex market. So we look at what harmonic pattern is, types of harmonic patterns. We have the four types: Gartley, butterfly, bat, crab. We look at some factors to consider and we conclude, and I will give you live examples. Okay? So what is harmonic patterns? Okay? It is using Fibonacci numbers to define precise turning points. We all know what Fibonacci numbers are. Unlike other common trading methods, harmonic trading attempts to predict future movements. Okay? Well, they apply specific Fibonacci retracement and extensions to a price structure. As we said before, this pattern can be quite powerful and often give you straightforward entry and exit points. The main advantage of this pattern is that they leave no room to guesswork and rely on specific Fibonacci numbers. So let's look at the types. So we have four types, as we said before, and for each type we have bullish and bearish formations. So let's pick the first one, the Gartley. So this is Gartley. So these formations are all based on Fibonacci number. You will recognize these Fibonacci numbers. You will recognize these all are Fibonacci numbers. So the price moves from, this is the starting point, X to A, and then it retraces to B by this Fibonacci number here, and extend and moves back up to C by that Fibonacci number there, and then finally it extends to D by this Fibonacci number here. So this is a complete pattern: X, A, B, C, D. So this is bullish pattern. So what this bullish pattern is telling us is time to go long. So for bullish pattern, look for long trade near D with a stop not far below. So if you go long from here, you put your stop right below D and you expect price to go up and probably hit B level, C level, and probably A level. So you have TP1, TP2, TP3. Okay, let's look at the next one. Is the Gartley as well, but this time bearish. Okay, so this is the D point where you are trading, where you're going to take a short trade, and when you're going to take a short trade, you'll be looking to put your stop loss just a little bit above that level there, and you expect price to go down. Okay, TP1, TP2, TP3. Let's look at the next pattern, which is called the butterfly. Okay, the butterfly pattern is different than the Gartley in that the butterfly has point D extension beyond point X. So in butterfly, if you look at the end point, which is the D point, is extended beyond the starting point. X was the starting point, but look at D point. Let's go back to the Gartley so you can see what I mean. This is Gartley. Look at D point. It's not extending beyond X point. It's actually not reaching the X point. This is the bearish Gartley. The D point is not extending beyond X point. But now let's look at butterfly. The D point is actually beyond X point. Okay, that's just the difference. And the Fibonacci numbers are also different. If you look at it properly, Fibonacci numbers are different. For this formation to go short, you are going to go short from D point, your stop loss above here, and you expect your profit at TP1, 2, 3 to be touched. Okay, this is the bullish of the butterfly. Also from starting point A, B, C, D with all these Fibonacci ratios, and you go long from D point, your stop loss below here, prices goes up. The bats, okay, what can you notice? The bat pattern is similar to Gartley in appearance, but the measurement different. So if you look at the Gartley point D is not extending beyond point X, which is what we said in Gartley. However, these ratios are different. All these ratios are different in the two type of formations. Okay. As usual for the bullish, you go long here, stop loss below here, prices extend upward. For the bat, the same thing apply. You go short here, your stop loss over there, and prices goes down. Okay. And the last one, the last pattern is called the crab. The crab is considered to be one of the most precise of the patterns. Okay. You could quickly see that the extension D is way far away from X. That is how you know this crab pattern immediately. Okay, so it started from X as usual, from X, A, B, C, D, with all these ratio numbers of extension and retracement. Okay, so here you will go long from here, your stop loss just below here, and expect prices to rise up. And the crab, bearish example of a crab is this. Similar situation, short from here, stop loss above, prices goes down. Okay, so these are the types of the formations of the Gartley patterns. All right, so now let's consider some factors, because you could see the patterns look like something good, but you need to know some characteristics and some factors to consider. Harmonic price patterns are precise, requiring the pattern to show movement of a particular magnitude in order for the unfolding of the pattern to provide an accurate reversal point. A trader may often see a pattern that looks like an harmonic pattern, but the Fibonacci level will not align in the pattern, thus rendering the pattern unreliable in terms of the harmonic approach. Well, this can be an advantage as it requires the trader to be patient and wait for ideal setups. Secondly, harmonic patterns can gauge how long current moves will last, but they can also be used to isolate reversal points. The danger occurs when a trader takes a position in the reversal area and the pattern fails. When this happens, the trader can be caught in a trade where the trend rapidly extends against him. Therefore, as with all trading strategy, risk must be controlled. So those are the two factors we need to consider. Second, the conclusion of this lecture or training is that harmonic trading is a precise and mathematical way to trade, but it requires patience, practice, and a lot of study to master the pattern. The basic measurements are just the beginning. Movements that do not align with the proper pattern measurement invalidate a pattern and can lead traders astray. The Gartley butterfly, bat, the crab are the better known patterns that traders watch for. Entries are made in the potential reversal zone when price confirmation indicates a reversal, and stop losses are placed just below a long entry or above a short entry, or alternatively outside the furthest projection of the pattern. Okay, now we have seen Gartley patterns in theory. We've seen it in theory. Now let me show you in real life. I'll open a chart and I'll give you live example. All right, so this is pound New Zealand, and this is a 30 minutes chart. So I got this indicator that just helped to draw the harmonic pattern really. So this one is not yet formed. It's still undecided because it's a precise calculation of the Fibonacci numbers. So it's trying to calculate the Fibonacci numbers to make sure that the pattern formed correctly. So let's go to find one that is already formed. Let's see this one. Oh, this is also still forming. Okay, yeah, it's still forming, not stable yet. Let's see daily time frame, week. Okay, we got this weekly time frame that is already formed. Well, to me, this one look like a crab, right? So we let this formation complete. So this is point X. This is A, B, C, D. So when this formation complete, we expect to go short from here, and so we are going to go short from around there. We put our stop loss just above there. Let's say our stop loss is a red. Let's make it that color there, red color. And let's say our take profit target, the first one could be actually be here. Let's make that green. Let's make that green. And second take profit could actually be here. All right. So look at what you are risking. That is the beauty of this pattern. You are risking just about 378 pips. Remember that we are on a weekly chart to make 1486 as a TP1, TP2 2,840 pips, just by risking how much? 379 pips. Okay, let's look at another one. Let's look at this one here. Okay, so this one is this is New Zealand, and this is a weekly chart. Let's look at daily chart. Okay, this is a daily chart. Okay, so for daily chart, okay, so here we are looking to go short once this pattern is complete at D. Okay, so let's say we go short there. If we go short right there, we put our stop loss just a little bit above there. Okay, let's say we put our stop loss just above this resistance line here, resistance area. Okay, put your stop loss there. But our first target will be here, and our second target could be here. Okay, our second target could be down here. So you went into the trade here, TP1, TP2. Let's see what we have in terms of risk. We risk 65 pips, about 65 pips to make first target, 254 pips, second target, 430 pips. So you see the risk reward ratio for Gartley, for pattern for the Gartley or the butterfly, whatever pattern you use, is very, very high. Okay, so harmonic pattern is a good way of calculating your entry and exit point to the last pips. So it's either the formation is there or it's not there. No guesswork. Okay, so guys, I hope you understand this topic. It is not the easiest topic to understand by any imagination, but some of you have requested that I should teach you this strategy or these patterns. Hence, I took it upon myself to show you how this pattern work. Okay, guys, I want you first of all to share this video. Secondly, I want you to make a comment on the video if you think it's a valid, or a little bit more about the patterns. If you have used it before, and also share it among your friends and subscribe to the channel. Okay, I hope I will speak to you in a short while again. So it's Dari.